New York's collapse is sparking panic all across the U.S. manufacturing sector, and for good reason, because I've been predicting that what was happening in other parts of the world was eventually going to hit right here at home. And now that it has, as you're about to see, the nightmare is just beginning. As New York factory activity contracts on weak orders and shipments. Now, I want you to understand this has serious implications not just for the economy, but for the labor market as well. Because when you think about manufacturing, even though here in the U.S. it only employs a relatively small percentage of the economy, the amount of money manufacturers spend into the real economy is massive. And that's one of the reasons why where the manufacturing sector goes, the services sector eventually follows. Again, this is a huge problem as we head into the holiday season because the services sector has been slowing down and at a rapid pace. And then you have the labor market. We've been hearing from workers. They're worried about their jobs. Or you're about to see the evidence firsthand. And how about monetary policy? Well, the Fed is meeting tomorrow, and we're going to get an announcement on Wednesday. Now, the market's pricing in a quarter basis point cut, but if there's one thing that could get an outsized cut, well, that's a slowdown in the manufacturing sector and the labor market. The problem is, as I'll show you, this is one thing a rate cut cannot fix. Let's take a look at what happened because the Federal Reserve Bank of New York's General Business Conditions Index decreased nearly 21 points to minus 8.7. And this is a massive drop. We saw this big rebound in the Empire State manufacturing. Everybody says, look, this was validation that the soft landing was in play and the demand was coming back. And I said all along, look, this is just front running of the tariffs. And sure enough, what are we seeing? It's rolling over, and not just a little bit, it's coming crashing straight down. And again, you talk about the issues the economy is facing right now, and we don't need to see a downturn in the manufacturing sector, because when that happens, one of the first things companies do is they start to slash hours, and then they slash jobs. And again, if you look at the timing as we head into the holiday season, what is the biggest issue every manufacturer, wholesaler, and retailer is facing right now? It's too much inventory. The measure of current new orders as well as shipments both dropped to the worst reading since April of 2024. So what you're seeing here is there's a severe lack of demand in the economy. And it's not just the problem of prices being too high and consumers seeing that their dollar isn't going as far. What you have is this massive inventory bill that started post-pandemic and got even worse during the trade war. And now all of a sudden, what are we facing? A severe drop in new orders, and that means shipments. When you see a negative print here, it means when you order something, it shows up a lot faster than you might expect. And what it is a sign of weakness at the manufacturing level, because if they don't see a big pickup in new orders, well, the problem is we also found out that backlogs continue to get wound down. And what that means is we're very close to an inflection point where there isn't enough new orders to sustain the workforce. And in fact, we're already seeing signs of that now. A gauge of factory employment contracted for the first time since May, and a measure of hours worked also fell. And again, you think about why this all gets tied together, because if there isn't enough business to keep your workers busy, well, you start cutting hours, and that's the first sign. Now, we also saw this in the JOLT survey as we saw businesses across the country start pulling job openings, because if you don't have enough new business to sustain your workforce, you most certainly don't need new hires as well. So the problem now that we're seeing in the manufacturing sector is if this contraction persists, even if just for a couple of months, what you're seeing is this leading indicator of hours work getting cut suggests that the labor market could be on the cusp of a massive unwind, and this could happen now in the next couple of months. Let's take a look at this chart, and you can see very clearly the unemployment rate in blue against average weekly hours of production and non-supervisory employees. So as demand drops and new business falls off, what happens is businesses, well, they simply just cut hours, because at this stage in the game, they don't want to lose a lot of their workers. And this is something we've been hearing from executives, that they spend a lot of time post-pandemic training people, and now that they have them trained, they don't want to lose them. So again, the first step is you start cutting hours and you hope things are going to turn around. The problem is, if they don't turn around and quick, well, then what you're going to see is the unemployment rate start to rise. And this is a relationship we see happening going into every recession. First, it's hours dropping, and everyone says, well, it's just temporary, it's just transitory, things will turn around. The problem is it doesn't, and next thing you know, the unemployment rate continues to push higher. What we can see based on the government data that hours worked is flat here, but the problem is what we're seeing in these surveys, and these are run every month and they're done usually after the payroll report, is it's a leading indicator of where the economy is going. So what this is telling us at the next payroll report is it's likely now, the probabilities are increasing that it could be a negative print, but we'll see a further decrease in hours. So you think back to that issue I mentioned with inventories. Well, what do everyone need to see happen right now? They need to see those inventories drop in a big way. But one thing that doesn't get them to go down is shrinking paychecks relative to inflation. And the problem for manufacturers is the price for raw materials as well as those received by them edged up somewhat. So yes, input prices rose, but at a slower pace. And yes, output prices also rose. So what we're seeing is manufacturers are reaching a point where, look, they don't want to pass on the price increases. And that means at a wholesale and retail level, you're going to see companies being forced to absorb them, because it's very clear, again, as hours go down, demand goes down, and these inventories, they're not going away. In fact, they're still building. At some point, you've got to clear them out. The risk now is you can see the nightmare scenarios forming, one where people are about to lose their jobs, into an inventory-led recession. Again, this is a dangerous place for our economy. But even if things unwind, it doesn't mean your trading account has to go down with it. Let's take a look at this trade we put on GDXJ back on the 5th. This is now, as of close this business Friday, up a whopping 9.95%. Now, this is from our Metre strategy. It went out to all of our subscribers. And since we launched that trade, well, I've fully optimized the strategy on a per security basis, meaning this thing crushes all the competition. Now, if you're trading other systems, stay tuned to the end of the show. Now, the great part about this, you don't even have to put a dime out to try it. Grab those links in the description below, sign up for either one of my reports, and you start getting the MetaStrategy trades at no additional charge for the next 30 days. Now, let's take a look, because we've been talking about inflation. In fact, that's the risk we're going to hear from the Fed on Wednesday, that they're still concerned about that. Now, you may remember the last CPI report, we saw it rose on a month-over-month basis between the core and the headline, somewhere between 0.3 and 0.4%. Now, why did that happen? Because producers jacked their prices way up the month before. Now what are they saying? Well, we're struggling to push those price pressures across. But the issue we have at hand is as weekly hours decline, well, inflation tends to go with it. You can see it very clearly back here in the 80s as the CPI, now shown in blue, declines right alongside hours. We can see going into the 91 recession that inflation was pushing up. But what was the issue we've been talking about for some time now is as wages or hours work continue to fall, consumers can't afford higher prices. They fall behind. So that means they're still spending in terms of dollar amount, a large amount. They're just getting less. And so that means inventories keep building up, and next you know, you're right into a recession. You see the same thing going into the dot-com bubble, the financial crisis, and that's the risk we have now. So if you're wondering why the Fed is so eager to get inflation down, why they're so worried about it, but the problem is paychecks are shrinking at a much faster rate. So the Fed is very aware, if they can get inflation down but keep the labor market intact, that means those inventories can get worked down, the economy can experience a soft landing and then rebound. But the problem we're facing right now, what we're seeing not just in the New York manufacturing sector, but all over the world, and this is something that's going to spread all across the country, is what we're seeing is manufacturing is leading the downturn. And this, my friends, is a major problem until these inventories get cleared out. And again, they're massive. You're going to see the economy dive deep into a recession and stay there for some time. But one of the challenges we're facing isn't just in the manufacturing sector. We're seeing a lot of small businesses starting to struggle right now. And what this is setting up for is a massive number of bankruptcies. Let's take a look at this headline. As small businesses turn to lending startups if tariff costs mount. Now, this is fascinating because a lot of people said, look, the U.S. companies aren't going to absorb the tariffs. The problem is they are, and they very clearly are. Now, when goods show up in the country, that's when the tariff is due in a matter of days. Let's take a look at what the issue is. Importers typically tap credit lines to help finance imported merchandise with the goal of paying down the debt as they sell it. And this is common all throughout the supply chain. And this is why you see that when the economy is booming, you see lending expand. And as lending expands, new money is created in the economy, you get inflation, you get prosperity. But when it starts to go in reverse, that's the problem here. So right now, what we're noting is businesses are still running as normal, but there's something new they're being forced to do. But tariffs must be paid within days of cargo arriving at U.S. ports, creating a big new bill before they've sold anything. And the problem is a lot of businesses are now paying around 20% annualized to borrow money just to pay the tariffs alone. Because what is the issue they have as a business? They don't have the money. Now, if they don't turn this inventory, and that's why I wanted to show you what's going on in the manufacturing sector here in New York and why it's going to spread all across the country. Because as they cut hours, you're going to see a lot of these businesses that are bringing in inventory, they're paying tariffs at a very high interest rate, and if they don't move it, not only are they going to risk going out of business, but they're going to risk going into delinquency and then eventually defaulting on that loans. It's going to backfeed all across the banking system. So you can see not only are we risking a massive inventory recession here, we're also risking a whole new type of financial crisis. I think you have a big cut, Trump told reporters on Sunday. It's perfect for cutting. But Mr. President, you don't want rate cuts. That's the problem here. Because at this stage of the game, when the Fed starts cutting rates, it's because the labor market's weakening. And the problem is rate cuts don't fix the issue with the economy. And that's why I wanted to show you what's going on in New York. Because if you think about this, if the Fed were to cut 50 basis points, but what if they were to cut a whole percentage point? At what point do consumers feel that? Does it change their mortgage payment? It doesn't. Change their car payment? No. Does it change the price of groceries or electricity? Not at all. It doesn't even impact their credit card. Now, it can, but usually with a several month lag, sometimes not even if the banks don't want to. And here you can see why advanced retail sales, adjusted for inflation shown in blue, do not react to rate cuts because it doesn't make a difference. And you can see going back to prior cycles, as you see a slowdown in demand, as the labor market's weakening, what happens? The Fed cuts rates. And does it have an impact? It doesn't, because the issue right now that's holding back consumers isn't the fact that they're going to the store and saying, look, I'd like to buy that and I really need to finance it, but gosh, it's just 1/4 or 0.5% too expensive on the cost to borrow, so I'm going to bypass it. No, what's happening is they're not going to stores because they're seeing the fact that their paychecks are shrinking relative to inflation. They're seeing there isn't enough new orders coming into their company, and they know the backlogs are getting worked through, and at some point, the risk is they're going to be on the unemployment line and there's no opportunity to get back. And this is the issue, not only here in the US, it's starting to spread. We're seeing it happen now in New York, but I've been warning it's happening all over the world. Let's turn to China because we're going to get a lead picture here of what's coming to the US. As China's economic slowdown deepens in August with retail sales, industrial output missing expectations. So you can see what's going to happen here in America. Because as paychecks continue to drop, that means spending is going to drop. Retail sales are going to come down. As retail sales drop, what happens? At the wholesale level, retail level, you get a big backup in inventories on top of the big backup we have now. The manufacturing level, what do they start to do? They start to cut prices, they start to compete, and they lay people off. Retail sales last month rose 3.4% from a year earlier. And again, that is a slowdown from July's 3.7% growth. So again, as the global economy continues to cool off, you can see exactly what's happening in China has already started to happen here in the US. This is why we're hearing from a lot of surveys that are saying, look, the holiday season, US consumers saying dollar-wise, they're probably going to spend about the same, maybe a little bit less, but they're very aware they're going to get fewer goods. In some cases, households are saying, look, we're going to cut 5 to 7% of our spending. For a lot of retailers, this is the worst thing they could hear right now. And as a result, that leads to a drop in industrial output. You see in China, the growth slowed to 5.2% in August compared to the 5.7% jump in July, making it now the weakest level since August of 2024. So what we're starting to see is that air pocket that we've talked about. When you pull forward demand and you continue to pull forward any possible way, at some point you reach the level where you pulled everything forward, and next thing you know, you hit an air pocket. We see it started in China, and we're going to look at the effects of their economy. You can see it happening now in New York. It's going to spread all across the country. And China's consumer price index fell more than expected last month, dipping. It's in contraction, minus 0.4% from a year earlier, while deflation in producer prices persisted for a third year. So you can see all this worry about inflation here in the U.S. Yes, on a transitory basis, we could see it go higher, but as demand continues to fall, particularly if demand falls faster than prices, we're going to see deflation just like China. But the issue at the producer level in China is they're fighting over business, and that's leading to 3 years of deflation. So you think about the impact it's going to have here on U.S. companies. They're already starting to cut jobs. They're wanting to try to preserve their stock price by continuing their share buybacks. The problem is they're going to have to dip into that money at some point to continue to compete, because what's happening as prices fall, businesses go into survival mode. But in China, they had a different path. They said, look, we're going to get everybody to cut production. Factory deflation in August eased for the first time in 6 months, offering an early indication that Beijing could be making headway with this anti-involution drive. Of course, I love how they come up with a term for this. The problem they don't realize, if you're going to defend price, what's going to happen is you're going to lose jobs. And that's why what you're seeing in China, and this is eventually going to happen, maybe in the next 6 months or year, you're going to hear talk about stimulus, particularly from the tariff money. That's where it's going to come from. You watch and see, because China's broad economic slowdown raises stimulus expectations. And the reason you're going to see this happen all over the world is very, very simple. I want to show you on the next slide, because again, it has everything to do with inventories and demand. The problem is demand is very, very weak right now. You can see, looking at real retail sales going back to late 2021, they just fell off a cliff and, well, have been mostly negative since then. But look at the inventory growth rate at retailers. It broke that horizontal black line, went into positive territory around early 2021, and has continued to stay in positive territory. Problem is, we have way too much inventory, not enough demand, and that's a recipe for stimulus, but it's also the recipe for a prolonged recession. And based on all this borrowing for tariffs and other things, we could be facing a whole new breed of a financial crisis. Now, even if the global economy plunges headfirst right into a recession, doesn't mean your trading account has to go with it. Let me introduce to you our Metre strategy. Now, this is fully optimized on a per security basis. So our Metre strategy, it combines 9 strategies, each individually optimized on a per security basis. And look at the results on this. Total returns beating a buy and hold on the S&P 500 going back over the last 3 years. What do you have? 69 trades with a whopping 66% win rate, max drawdown of minus 7%. Now I'm going to show you this compared to the Bravo 9. Now I have found out since I've started saying this that Bravo says, look, you can't use this as a standalone strategy. You have to use it with other tools. Then what good is it? Because it doesn't work. And that's my point. And here's the test. I built a custom backtest engine to compare every strategy and optimize them. What do you have? Total return, missing buy and hold, half the number of trades, and a poor win rate and the same drawdown. So my friends, if you're using any other strategy, it's time to make a change. Our Metre strategy is changing the way people trade and putting money in their pocket. Now, what is it? It's an advanced trading system that combines 9 professional trading strategies into a single intelligent signal generator. It generates 31 times more frequent buy signals, and this was before optimization. Now, right now, it is optimized for a 10-day hold, and this thing just crushes it on the numbers, generates hundreds of trades per year, and has a success rate, as you can see, over 60%. And again, how do you get this? Well, you've got to sign up for one of my reports. Now, if you want to trade against machine positioning, we call that CTA Timer Pro. If you like trading those technical indicators and momentum, well, that's our Momentum Timer Pro. You sign up for either report. Now, you get that report and you get all the signals from it, plus you get the optimized Metre strategy trades. I give you my opinions on the best trades. We give you risk control levels. We give you a full tracking of all our open trades and returns. And on top of that, a weekly update. And again, the best part of all, you don't have to put a dime out to try this. Grab those links in the description below. Use a coupon code for your free 30-day trial. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.